Good afternoon, and welcome to the 2017 Realtors Legislative Meetings and Trade Expo Town Hall. We're glad you're all with us today. I'm your host, Stephen Gasquet, and joining me is Jerry Giovanello, NAR's Senior Vice President of Government Affairs. Jerry, welcome.
Thank you. Good to be here.
We're glad you're here. Jerry, some quick housekeeping items. Every year, we allow our members to ask questions during this session about the important work they're going to be doing up on Capitol Hill next week. Same format this year?
Yes, it's important that they get their questions in and answered. And later on, we'll have our lobbyists with me.
Perfect. Perfect. Thank you, Jerry. Now, when that happens, to submit your question, there will be a little button on the top of your screen. Just click on the Email Questions button, and we'll make sure that your question gets into the queue. So, Jerry, let's start out with a question about next week's work up on Capitol Hill. On a scale of 1 to 10, how important is it for our realtors to go up to Capitol Hill and talk to members of Congress?
I think this year, on a scale of 1 to 10, it's a 12. Very bluntly, there's a new president, new Senate, many new House members, and they're dealing with issues that are very important to us. So it's extremely important that we connect everyday people like lobbyists and our policy people with our realtor constituents. Very important.
There's a lot of work to be done this year, a lot of issues. Can you tell us about them?
Yeah, the way we develop our issues, more or less, they're realtor-driven through our committees. Lobbyists and our policy people get their direction from realtors who are in the community, on the ground every day, and they develop our policy on that. And I think the congressional agenda often determines where we are at any particular moment. I mean, it doesn't mean that we're not assigning importance to other issues. In fact, we have about 38 pages of bills we're monitoring and committees we participate in with hearings and letters. We ask questions. So there's a lot of activity going on all the time here.
Well, now, again, let's remind our listeners, Jerry, that to submit your questions, just click on the Email Questions button at the top of your screen, and we'll put it in the queue. So, Jerry, now, let's talk about the big ticket item up there, tax reform. What should we know about that?
Tax reform right now is being debated, but it's not being debated as a bill. It's being debated on one page of proposals from the president and something called the Republican Blueprint for Tax Reform and Growth. And so we don't have the details on it, but we know enough about it that essentially, while we support tax cuts and simplification, we do not support proposals or bills at doing the tax cuts or simplification at the cost of home ownership. And that's where these bills are pointing to right now, are these proposals.
Well, let's drill down into this, Jerry. It seems that the tax rate reductions offered by the Trump tax reform plan would help businesses, and it's hard to see why our leadership would oppose this plan. I mean, after all, if everyone is getting a big increase in the standard deduction, how can we lose?
Well, we can lose because when we ran the numbers, it's turning out that under these proposals, homeowners would likely face about an $800 tax increase. Renters, on the other hand, would essentially have a tax cut of about $500. That's a problem for us.
So, a member is up on Capitol Hill, sitting right in front of their member of Congress. They're having a conversation, and the member of Congress says, "What do you think about the tax reform blueprint?" What do they tell them?
Here's what they tell them, and it's important to get right to the point, that since 1913, tax codes, which essentially determine behavior, the tax codes have included incentives for home ownership. That's been there. And to think about a bill that removes them, we think is very, very serious on that. And these proposals seem to be aimed at the middle class, and it actually, we think, makes it worse for the middle class. The tax cuts are quite frankly, skewed toward the upper end of income earners. And I think the other part of what we have to say is that under these plans, if they become law, the value of a home would drop about 10% early on, and who knows how much later. So these are, I think, important issues to bring up.
And remember, of course, we're going to be taking your questions throughout this webcast. You'll see a button at the top of your screen that says email questions. Just press that, write your question, and we will get it here at NAR in Washington. Now, Jerry, a big question about commercial real estate. Many of our members are investors. Many of their clients are investors, and they've come to expect deferred taxes on the sale of their investment properties, so they can then plow all their profits into their next place. What about the 1031 like-kind exchange? Is that safe right now?
It's not really safe for several reasons. One, it's not mentioned, and as I was saying, Congress is always looking for pay-fors, piggy banks to finance tax cuts and so on. So it is widespread, our usage, and commercial people also. And because it's not mentioned, it's going to be hard to lobby. I mean, in the sense that we think the current system of tax deferral is important for economic growth. So Section 1031 is one that we have to be very aware of on that.
Would a member then be better off not to mention it or to mention it? What's your opinion?
I think they could mention it in passing along the lines of we're being vigilant on other sections of the tax reform proposals. And even if they were not a bullet point in the president's one-pager or in the blueprint, they should say, we're aware of this, it's used much more often than you think, and it's a real generator of economic growth.
And again, it's not a tax break, it's a deferral. You have to pay them eventually.
Really. I think Congress's assumption is that these will continue at the same rate if they delete Section 1031. Nothing could be more wrong than that.
Jerry, thank you. And remember, you can ask questions. Just click that email questions button at the top of your screen. Jerry, now let's turn to flood insurance, a huge issue all across America. The National Flood Insurance Program is set to expire on September 30th. Could you tell us a little bit about how critical it is for Congress to pass a long-term reauthorization of the NFIP?
Yes, the flood insurance program is available in about 33,000 communities. And in those communities, if you are involved in a mortgage that has FHA or Fannie and Freddie backing, you need to get flood insurance in these communities or have it available. The last time it lapsed, where the program was not reauthorized, there are about 40,000 transactions in the pipeline that just came to a halt. People did not get their homes. Mortgages were not given. Confusion in the lending industry. So this is critically important to tell Congress that you can't let the program lapse, and we need to see some reforms on it. And that's what we've been working on the last year or two.
And that really gets in the way of the whole transaction cycle, because that person can't sell their house, then they can't buy another house, that next person can't sell their house, it just goes on and on.
Exactly, and I think we've done a good job, our realtors have done a great job educating members of Congress that whatever else you do, don't let the program lapse. We could continue talking about developing a consensus on how the program is reformed and so on.
Now, in addition to the reauthorization of the NFIP, what about private market options for flood insurance?
Yeah, this is an important topic. First of all, NAR opposes the privatization of the flood insurance program the way it's done now, but we encourage private insurance companies to get into the flood insurance market. And we have supported several bills on the House and the Senate to push that, and we're always encouraging co-sponsors to that. I think it will be included in the general reform and reauthorization, how you encourage private insurance to get more involved in flood insurance.
Of course, you know, step one of flood insurance is where is your house located? Are the maps that exist for flood zones accurate? Should they be changed?
They should be changed. They're not exactly modernized to the extent that they can be. Now, modernization involves funding, and recent budget proposals have actually cut flood mapping. This is causing a problem in Congress, by the way, because floods come suddenly and people never knew they needed insurance or that they were in a flood zone.
Right.
So that is a key component of where we go from here to improve the program.
It's always so interesting that one issue like flood insurance, it's not just one thing. It's 6 things. There's so much happening at once.
Yeah, welcome to Congress in Washington, D.C. Yeah.
Well, Jerry, let's turn now to our last talking point, protecting sustainable homeownership. You know, Fannie Mae and Freddie Mac have been in conservatorship since 2008, almost 10 years. How do we responsibly reform those government-sponsored enterprises, and what should our members tell Congress about that?
Here's what conservatorship has gone on now for about 8 or 9 years, and that's unsustainable in the long run. So we have to kind of reinvent the secondary mortgage market, and we do support restructuring of secondary mortgage market so that financing for mortgages is available, affordable, and it's there under all kinds of economic circumstances and regional differences there. That's a key component of where we are.
Interesting. Of course, Jerry, one of the most amazing things about American home ownership is the 30-year mortgage. The idea that someone can buy a house when they're 30 years old, lock in a rate, and keep that exact same mortgage payment until they're 60 years old. That's amazing. Is that safe?
In the whole debate about how we replace Fannie and Freddie, that will be a part of it. And Americans have become used to having a predictable payment each month. I think it's ingrained. It enables budget planning and so on. It's a real safety kind of item for home ownership. Other countries have other incentives for home ownership, and so this is one of them, and it is important.
So when our members are on Capitol Hill, would you recommend that they stress the importance of the 30-year mortgage?
Absolutely, because as we reinvent Fannie and Freddie, there's got to be a federal guarantee that 30-year mortgages will be guaranteed, essentially. That's a critical part of any replacement for Fannie and Freddie.
Jerry, let's start our next question with a little definition for all our members about exactly what a G fee is and what it's supposed to be used for.
Yeah, G fee is short for guarantee fee. And lenders, when they make a mortgage, package it and send it to Fannie and Freddie, who then charge the lenders a fee for this. Now, the lenders are not going to absorb that fee for taking it off, so it's usually passed on to the person buying the home on it. Now, this has been, quite frankly, lucrative for Fannie and Freddie because they have to sweep all of their profits back to the U.S. Treasury.
Right.
So what's been happening is, in this era of no taxes or tax increases for anything, from gasoline to whatever, what they do is the Appropriations Committee looks for other piggy banks of money. And this Fannie and Freddie guarantee fee was proposed to pay for the highway bill. And we fought that and were successful in removing it.
Which has nothing to do with real estate or home ownership.
That's what we tell Congress, so
Right.
Not monthly, but very often, because it's still out there as a piggy bank. And it should be used for what it was intended, to keep Fannie and Freddie strong and risk management issues.
Another one, Jerry, that our members are going to be talking to members of Congress about. What is NAR's position on PACE loans, that is property assessed clean energy, like solar and other alternatives?
Right. This is important because we've always supported energy efficient homes and so on. And the thing here is the difference about this loan is that it is repaid through your taxes. So your tax bill will include what you owe on thing. Now that might sound good. The other caveat is that this loan through your taxes really never goes away because the next owner of the property is assuming this tax lien.
Right.
Now, we think that, first of all, it's states that are involved in this, California particularly, but it's growing across other states. And the problem is that we've convinced Fannie and Freddie not to buy these loans or to discourage them. FHA, we've not been as successful, quite frankly.
I see.
And I think the solution lies in disclosure and supporting consumer protections for these kinds of loans, that they should be very apparent and transparent as to what the current owner is doing and how it's going to be transferred to the next owner. It's a problem.
Jerry, before we take a quick break, one more question for you. If a member of the National Association of Realtors was up on Capitol Hill and had one question, and one question only, for their member of Congress, what would you recommend that question be?
I think it would go back to home ownership, the American tradition of encouraging it, and essentially you could boil everything we've talked about down to, do you want a nation of renters or do you want a nation of homeowners? That's the question.
Wonderful. Jerry, thank you.
Thank you.
And of course, our conversation will continue. We're going to take a short break, and then we'll bring the rest of the lobbyists onto the set to answer your question. Now, if you haven't submitted a question yet, now would be a great time. Remember, just click the email questions button on your screen. We'll see you in a minute. And welcome back to the 2017 Realtors Legislative Meetings and Trade Expo Town Hall. I'm Stephen Gasquet, and we are delighted you could join us today. I'm joined by Jerry Giovanello and the NAR lobbying team to take your questions from all across the country. Now, first of all, I'd like to start with a little bit of housekeeping. Welcome, everyone. We're delighted that you're here today. And we'd like to remind everyone who is watching today about an event that's coming up during the mid-year meetings. It is the May 16th date, 8 a.m. at the Marriott Wardman Park Hotel for the Federal Legislative and Political Forum. This forum will be fascinating. It'll feature Ron Insana, a highly regarded observer on domestic and global economics, financial markets, and economic policy issues. Ron is a senior commentator on CNBC and MSNBC, where he discusses the most pressing economic and market issues of the day. Ron will discuss how the congressional agenda could potentially affect the way realtors conduct their businesses. And now we're delighted to report that we've got some questions coming in. My first question is for Jamie Gregory, Deputy Chief Lobbyist. Jamie, welcome. How are you today?
I'm doing well, thank you.
Jamie, the question to you is, Jamie, we must strike a fine balance when it comes to tax reform. How do we support tax reform in Congress while making sure that the current real estate tax provisions that are so vital to the housing market and the economy are not eliminated?
I think the key phrase that you used is balance. It is a balance. Yes, the tax code does need to be simplified. We do need more growth in the economy. However, we shouldn't be taking away the incentives for home ownership and real estate investment that have been in the code for, in some cases, 100 years.
Jamie, also, wouldn't the 15% tax rate apply to most realtors' incomes and offset any negative benefits of the plan on home ownership?
I don't think you can say that. I mean, you have to look at what will happen to the market and the industry in general. If the market goes down, your income will go down. So it most likely will not be offset by whatever gains you get in the individual tax code.
Sticking with taxes for a minute, what about the 1031 like-kind exchanges, Jamie? I mean, are those still in danger? Jerry and I talked about them just a few minutes ago, but the president's plan does not seem to mention them.
That's true, and neither did the Speaker's Blueprint for a Better Way. However, the plan before that by Chairman Camp in the last Congress did. And I think in this environment, when you're talking about raising revenue through tax reform, everything is on the table.
Jamie, thank you. And again, please make sure you join us at the Regulatory Issues Forum on May 16th at 10 a.m. at the Marriott Wardman Park Hotel. This forum will highlight issues important to members, such as flood insurance, regulatory reform, and federal housing issues affecting millions of homeowners and small businesses across the country. Part one of the forum will feature Dr. Ben Carson, the Secretary of the United States Department of Housing and Urban Development. Part two will feature Director Roy Wright, Deputy Associate Administrator for Insurance and Mitigation for the Federal Emergency Management Agency, which we all know as FEMA. Speaking of FEMA, our next question is for Ken. Ken Wingert, Policy Representative, how are you, Ken?
I'm good. Thanks, Stephen.
Good to see you today. Now, Ken, let's take a look at FEMA right now. One of the top priorities for flood insurance reauthorization is mitigation. Could you explain that to our viewers? What does mitigation mean?
Sure. Mitigation very simply means to lessen your risk. And one of the things that we're focused on as part of the flood insurance reauthorization is to make sure that homeowners have adequate access to funds and programs to lessen their chances that they may flood, which is not only good for them, but it's good for the overall health of the flood insurance program. So that can mean everything from elevating your house to installing flood vents to flood control at the local level. And we want to make sure that that funding is available before a storm happens, before there's an event, because it's a lot easier for folks to focus on what they need to do then rather than once they're displaced from their house. It's also a better cost return for the taxpayers instead of paying disaster assistance on the back end.
A good point here, though. In an era where we're trying to reduce the deficit, the NFIP is $25 billion in debt. Does that make your job harder?
It does. It does. There's definitely going to be a debate, and I'm sure some folks will be asked by their members of Congress what to do with the debt. I think the answer to that question is, first of all, Congress needs to figure out how to address the debt, whether it should be forgiven or whether there should be things to lessen it. But the key is to get the program on a sustainable path, and that means doing things like mitigation, doing things like better mapping that assesses the risk that Jerry talked about, making sure we know where the risk is at so we're insuring it properly.
More questions are coming in, and remember, you can ask questions. Just click the email questions button at the top of your screen. Continuing now with Ken, what is NAR's position, this is a big one, on health care? There are many realtors and members of their families who are sick and who have pre-existing conditions. They'll lose health coverage and might not be able to afford nor will qualify for health insurance under AHCA, which was recently passed in the House of Representatives. Big issue, Ken. What do we do?
Big issue, and I think we should step back for a second. This is an issue that NAR has been involved with over the past 10 or 15 years. On the side of, as you pointed out, realtors are independent contractors, self-employed, so they are subject to those challenges in the individual market. Things like pre-existing conditions, we've supported efforts to that have made changes for those things to be banned in the past. We did not take a position for or against the ACA Obamacare, and we have not taken a position for or against the bill that recently passed the House. What I would say is that we're actively involved in making sure that Congress knows where the interests of our members lie, and that if you're thinking of this as a baseball game, we're probably in the second inning in terms of where we're at in terms of the changes to the health care plan. The Senate has a long ways to go, and they still have to reconcile a bill, so we'll be actively involved. But right now, we've got a lot of big issues on our plate, like tax reform and flood insurance, and I think in the limited time we have in Hill meetings, sometimes we only get 10 or 15 minutes with a member of Congress or staff, that we should really focus in on those issues. And if you do have, people have very strong opinions about health care, it's a very personal issue, it's become a partisan issue, quite frankly, that they should focus on talking to their member offline when they're back in the district.
Thank you, Ken. And another reminder, don't miss the NAR 360 event on May 16th at 4 p.m. at the Marriott Wardman Park Hotel, and get a member and director update on the key issues of the association and a rundown of the can't-miss meetings during the week. We still are getting your questions in, I'm glad to say. Colin, the next one is for you. Colin Allen, Legislative Representative, welcome. How are you today?
Doing well, thanks, Stephen.
Delighted. Now, Colin, what is the Trump administration's plan to reform the secondary mortgage market?
So in terms of the secondary mortgage market, this is Fannie Mae, Freddie Mac. What we've heard from Secretary Mnuchin is that this is going to be an important issue for the president as they move their agenda forward. At this point, it's just unclear whether they're looking to do something kind of incremental and slow steps, or to take a radically something that would replace Fannie Mae and Freddie Mac, or drastically alter their structure.
I see. Colin, the next question, G fees. Jerry and I talked about it just a minute ago. Will the United States Senate introduce legislation like the U.S. House to prevent G fees from being used to fund government spending unrelated to housing?
So we know it's something they're working on. Chairman Crapo of the Senate Banking Committee has led the efforts on that in the past, and now that he is now chairman of the committee, usually the chairman like to kind of make sure that their members on the committee get credit for this, and I know he's actively working with the committee to find somebody to work with him on that and lead that effort on his behalf and work it into a larger package.
Colin, one more for you. PACE loans. What's up with PACE loans?
So, PACE loans, property assessed clean energy loans. NAR has traditionally been supportive of clean energy and energy efficiency improvements. Here the deal here is that these are, as Jerry said earlier, they're assessed as they're a tax assessment. They stay with the property for a long time, and they can encumber deals. They're not subject to the same disclosure requirements, and they have caused concerns with Fannie Mae and Freddie Mac in the secondary market as far as buying these loans that would be encumbered by these. So we're worried about the disclosure there and the effect that those loans may have on the secondary mortgage market.
Well, Colin, thank you. Another reminder for you, May 17th at 7 a.m. at the Marriott Wardman Park Hotel, we'll be hosting the Federal Priorities Issues Briefing. Jerry and the NAR policy staff will provide information, analysis, and perspectives on NAR federal priority issues. And I'm delighted to say we are being flooded with questions from Realtor members across the country. Realtor members who will be here next week to meet with their members of Congress, thank you for coming to Washington, and thank you for joining us today, and also thank you for your question. Let's take a look at what we have here. First of all, for Jamie, tax reform. Can you explain how the mortgage interest deduction could be watered down in the tax reform bill?
Yes, excellent question. So in the blueprint and President Trump's outline that were released, they do something very stealthy. They keep the verbiage of the mortgage interest deduction in both. However, they eliminate the state and local deduction, and at the same time double the standard deduction. So remember that most people don't itemize until they buy a house, and it's the combination of the mortgage interest deduction and the state and local that gives them enough economic benefit to itemize instead of take the standard deduction. So if you're going to expand the standard deduction and take away one of those pillars, in their own analysis that was put out by the speaker, less than 5% of filers will itemize. So if you're not itemizing, you're not using the mortgage interest deduction, you're creating no difference between renters and owners.
I've got to say that in my stack of papers we've been getting of the questions from members, I'd say it is 8 out of 10 about tax reform.
Not surprising.
It's a big, big issue.
Not
So let's
surprising.
continue in that right now, if you don't mind, Jamie. This realtor writes, will NAR have any information that we can give to our legislators showing the numbers, the impact among the homeowners versus renters? There were some great examples used last year during our conference. That's a good question.
So I'm actually not sure exactly which number they're looking for when you say the impact between renters and owners.
I think they would like to show about the economic impact on households
On a household.
if this were to go through for a renter versus someone who owns their house.
Right. So the initial analysis that we've done, that we outsourced and have just gotten back, shows that for families with incomes between $50,000 and $200,000, that they would be they'll pay a little over $800 more in taxes. Renters in that same group will pay a little over $500 less. So you're creating a disparity. Homeowners already pay the majority of taxes, so you're increasing that burden. I would also say that the initial analysis shows that home values, because if you're taking away the incentive, you're going to have less buying activity, that home values will drop on 10%, at least 10%, and possibly more in high-cost areas. So you're also going to have a drop in valuations.
Earlier in the webcast, we were talking, Jerry and I were talking, and you estimated that the new tax reform plan could reduce the value of homes in America by 10%. Our members are listening, and this question is, how do you know that?
Do you want me to? Sure. Yeah, so this is actually interesting. Some of you will remember that back in the 90s, there was a proposal called the flat tax that would have eliminated all deductions. And we had extensive, well, not just us, but we did extensive analysis at that point, as did others. And at the time, the average drop in valuation was determined through econometric modeling that it would be 15%, and in high-cost states, as much as 22 to 25%. So this is a different proposal, not as extreme as that, but we're still being told by outside sources that we're going to see a drop of 10 to 12% across the board. Now, we just went through a recession that was partially caused by drop in home valuations and the impact on economic activity that created. So I don't think we want to go through that scenario again.
And again, we're getting flooded with tax reform questions here. So Jerry and Jamie both, you might be on the hot seat for a few minutes.
I may share some of these answers.
Here's one from a realtor. What specifically in the tax reform discussion would affect homeowners and increase their taxes by $800 per household?
Well, I'm going to do you want to
Sure.
spread the wealth here a little bit so I'm not the only one answering?
Well, Stephen, there's a number of things at play, and I think a lot of folks who have listened to the simple one-page plan that the administration put out or that's come from the House just saw the mortgage interest deduction is left intact and that the standard deduction doubles, which sounds great on its face. But what they also do is get rid of a lot of other things underneath the surface, like personal exemptions that you're able to claim for you or your spouse, or if you have dependent children, and those things go away as well for those households. So when you combine the elimination of that, and especially in the areas that have high state and local taxes, we have a lot of states where property taxes probably exceed what the mortgage interest is. When you combine those two, it really makes a disproportionate hit on people who already own their house. And our position is that we shouldn't be paying for corporate tax rates on the backs of American homeowners. And as Jamie pointed out, we've also seen what happens when we have a 10% drop in home values. It's not great for the economy. So there's a lot of interplay in the tax. We've hired some very smart economists to model out how these things would happen in the larger economy, and we feel very confident in our numbers.
Sounds good. I'd like to change this topic for just a moment. We'll come right back to tax reform. But let's talk to Joe Harris, Legislative Representative. Hi, Joe. How are you today?
Great. How are you?
Good, thanks. Let's talk quickly about the VA loan. It's been called the best loan in America, but some realtors say it's too slow. That if in a competitive market, if you've got to move really quick, the VA loan's not fast enough. Tell us about that and what can be done to change that.
Well, you're right. The VA loan is quite popular. It has bipartisan support. It's been around for a very long time, and it's something that NAR supports. I think where some of the talk about the sort of the lag may come is with the appraisal process. We had a hearing about that recently, and we looked at reasons why it takes a little longer to get an appraisal, particularly in more rural areas. But it's something that we're looking into, and we'll be working with Congress on that.
That sounds good. Flood insurance. Ken Wingert. I wonder if you could field a couple of questions
flood
there.
questions, Stephen?
Yeah. Well said. Flooded with questions about tax reform and a few about flood insurance. Here's a question from a realtor. Please keep in mind flood insurance is not a real estate issue, it's an economic issue. Many others benefit from vacation homes along our coast than just the owners. I have asked our local chamber, home builders, retailers, and others to join us in contacting our U.S. representatives supporting reauthorization of the NFIP. Now, this is an engaged realtor who gets it. This is wonderful. What do you think?
I think that's great, and I would encourage other folks to do the same. The coalition pushing for reauthorization, which needs to happen by September 30th, just a reminder that that September 30th date is not as far off as it seems, is very large. It's real estate, it's local communities. There's 22,000 communities that are affected by the flood insurance program. It's, insurers and lenders, obviously. So we've got a large group pushing for this, but there's obviously a lot going on the Hill and a lot going on in D.C. right now. So we need to make sure that Congress is aware of that September 30 deadline.
As you know, we have 1.2 million members, and they all have their own opinions on things. So here's one, Ken. Isn't it highly unlikely that there will ever be a private market for flood insurance? Isn't this a prime example of why we have government assistance? It's not a sustainable business. Am I mistaken?
I think it's highly unlikely we will ever completely privatize the flood insurance program. The realtor who wrote is correct that there are certain areas where insurance companies are just not going to write. That's why we created the NFIP in the first place. But there's already private companies who are writing flood insurance in Florida, Pennsylvania, California, a lot of large markets, and they're not just doing it in low-risk areas. One of the concerns that people have raised on the Hill is that private insurers may come in and just cherry pick out the lowest risk, and insurers will tell you that's not how they make money. They make money on the high risk areas by, because they're able to charge higher premiums. So there is a market there, and part of the effort in this reauthorization is to see how much we can expand that market and take some of the risk off of the taxpayers' backs.
A question for Helen right now. Helen Devlin, Senior Legislative Representative. Helen, always a pleasure to see you.
Good to see you too.
Now, again, let's keep talking about flood insurance for a moment, if you don't mind. When our members go up to Capitol Hill and talk to their members of Congress, what would you recommend they tell them about flood insurance, what should be done in the long run and in the short run?
I think the most important thing is we need to reauthorize this program. We need to renew it before that deadline. We need to make sure that there are mitigation opportunities for people. I think we need to make sure that it maintains an affordable and available program, as well as provide incentives for the private market to get there. And that's why our talking point includes a bill, H.R. 1422, that actually kind of breaks down some of the barriers to the private market, some of the regulations. It does away with them so that they can, and it tries to really encourage the private market to happen. So I think we need to talk about all of that, but mostly we've got to get something done so we don't see a lapse in the program.
Thank you, Helen. I appreciate that. Now, Dan, Senior Legislative Representative, one for you. Again, we're sticking with tax reform. Back to tax reform, rather. You left tax reform too quickly. What about the deductibility of state and local property taxes? Talk to us, Dan.
Well, that's something that people are generally taking advantage of. And as Jamie and Jerry had said earlier, it's important that we maintain that so that people can continue to pay fewer taxes. When you don't have that deductibility of the state and local taxes combined with what they're saying is keeping the MID, we're looking at people not being able to take advantage of the benefits of home ownership. And as was stated earlier before, homeowners pay more in taxes than renters do generally. And so it's very important that we insist that state and local be able to be deducted as well.
Interesting. We have a number of questions still coming in, and there's still time. There's still time to get your questions in. If you hurry up, write a question. We'll try to get it in the queue before the end of the webcast. Okay, back to tax reform again. With the new tax reform, will we realtors have to become LLCs or corporations in order to benefit the business write-offs? I'll keep that as an open question to anyone.
I think that's to be determined. I mean, I think that's part of the details that we haven't seen yet. I mean, I think one thing to remember here is we have a long way to go. We've had two very vague documents produced. The Ways and Means Committee has not produced a draft of any legislation. They just had a retreat of the Republican members of the committee, and I think it's going to be a while before we see that kind of detail.
Talking about details, another question. In your review of the blueprint of President Trump's proposed budget, proposed tax reform plan, I think they mean, are there any discussions or proposals to reduce or eliminate any business deductions or Schedule C use by small businesses?
So the Trump, the administration plan was silent on business interest deduction, but the House blueprint does call for the complete elimination of interest deductibility, which obviously real estate's a highly leveraged asset that and folks take out mortgages to fund their purchases, and so that's something that, when combined with the elimination of like-kind exchanges, does concern us, especially on the commercial side.
Here's an interesting question about upper income earners. Is anything being discussed about upper income earners being able to deduct the full interest paid on mortgage interest? If we let some lose their ability to deduct MID, we will eventually see all lose their ability to deduct MID. Thoughts?
Well, I don't think it's, the conversation is about an income cap. I mean, it's still being discussed as the amount of interest, you know, the $1 million of interest.
So it's not about how much money you make, but how much money you've borrowed on your mortgage.
Correct.
Okay. Finally, homeownership being at a 50-year low. This realtor writes, how do we combat that when someone says, well, then it appears your homeownership incentives aren't working?
Well, I think, well, feel free, I mean, others can jump in, but I think that the situation would be worse if what is in place wasn't there. You know, every Western government has some incentive for home ownership. So I think that we would be even below a 50-year low, or even lower, I should say, if the incentives that we have weren't there.
Well, Jamie, thank you. I think we have a couple more questions coming in. Thank you. Okay, again, tax reform. Boy, tax reform is just dominating this
Not surprising.
conversation.
Not surprising.
That's wonderful.
It's top of the news.
You have stated that the home valuation could decrease by 10%. Please project the impact of the valuation decrease on local communities' real estate tax revenue and local communities' budgets. Now, that's a math-laden question, but it's
Correct.
an important question.
Right, and I think the impact that they're alluding to in that question is correct. Obviously, you know, we're not going to have a numerical answer for you here, but I think the domino effect that is part of that question is correct.
And this is going to have to be the final question for you, and this is one that could affect every realtor listening to this right now. And that is, couldn't the tax reform plan actually help our members, their businesses, and their incomes?
All right, so do you want to? I mean, we could share the responses here. Do you want to take it, Jared?
Not the way the proposals are written, and from the preliminary research we've done and have run some numbers with some outside sources, it doesn't appear that way, not at all. And why should homeowners finance tax cuts for corporations? That's an important question.
Okay.
I think that's actually a great final question, because it wraps us around to the first question that you asked, where I think that you know, you can't look at your personal income and what would happen, because or I should say your personal return, because your income may go down if the market goes down.
Right.
And so I think we kind of wrap around to that very first question that we had.
I would just chime in too that, you know, the president's put out a very bold plan in proposing, and somebody asked a question about a 15% pass-through rate. I think the likelihood of a 15% rate occurring is about as likely as, you know, me quarterbacking in the Super Bowl. It's probably not going to happen. So I think there's a lot of details that need to be filled in, and you have to think about all of those. Remember, all other deductions are gone under these proposals. So aside from charitable and, in essence, mortgage interest, which are really not there either. So all those other things that you claim on your personal or your business return may go away as well. So keep that in mind, that, you know, the low rate may not be what it seems to be.
One more final comment. Jerry, next week, thousands and thousands of our members of the Realtors will be here in Washington going up to Capitol Hill. One more word from you, Jerry, about how important it is that they come.
It's extremely important for this reason. You know, we have a new president a new Congress, new members of the cabinet, and usually you have a honeymoon. Now, this honeymoon seems to have been taken on a tropical island with a volcano and a hurricane happening at the same time. It comes down to there's an awful lot of confusion and uncertainty. I think what Realtors can remind Congress of is that, the bedrock of the economy and all of our principles have been, for 200 years plus, home ownership and real estate and strong communities. And I think that has to be re-emphasized to kind of calm things down. And remember, it's often said we're a nation of immigrants. None of us came here to rent.
Well said, Jerry. Thank you. And Jerry and all the lobbyists here at NAR, I'd like to thank you for joining us today. Thank you also for all the great work you do on behalf of American homeowners and property owners from coast to coast.
Thank you.
And I'd especially like to thank you. If you're coming to Washington next week, thank you. The work you do on Capitol Hill counts. It's important, and we couldn't be happier than the fact that you're going to join us right here in Washington next week. We'll see you then. Safe travels.